preparing to leave, stream the meeting. Should be quicker. I'm not sure what's. Okay, we are live. All right, we're live on YouTube. So again, welcome again, guys. There is more people waiting, so let me just let them in. I will share my screen. I've got probably 5 slides today. And as you probably noticed, slides today, because usually, you know, these meetings are supposed to be about business operations. But today I want to speak about, discuss with you the capital, raising capital for our M&A activities. And this is probably why more people joined today than the last time. Because we all like capital. So again, let's keep this meeting kind of like a discussion more. Please interrupt, ask questions in the meantime. I have 5 slides. I want to share with you something based on my experience, personal experience. Again, today's episode is about unlimited capital for M&A and unlimited. Well, let me just maybe open the. This kind of. So when I say unlimited, I really mean it. Again, why? Probably you've heard this, that, you know, there is $4 trillion of dry powder, which means in this Wall Street kind of language, which means this is the capital waiting to be deployed. $4 trillion, probably half of it is in the US. And we are expecting another tsunami of cash coming into the market, as you probably know anyway. So to be honest, guys, we have to leverage this current quite weird business and financial environment, because raising capital today is much easier and is easy. Is just easy. And I will just show a few examples of my experience, how you can potentially do it as well. So, okay, so let's start from this. What if I told you that raising capital for acquisitions is often easier than people think, but obviously only if you understand how to speak the right language and structure the deal correctly? What if I told you that raising capital is getting even easier now? I told you that there is another tsunami coming into the market, trillions of dollars coming in. So again, why not to leverage on that? I give you my real life example from my experience. Last year, I raised $80 million for a healthcare roll-up in the UK. That wasn't my project. I joined another company. So I worked with private equity firm for something called evergreen funding, and they offered us 50 million. I asked for 10 to 20 million for acquisitions, and they said, okay, we can actually write a check of 50 million, but you have to show us the deal flow, and you have to show us how you would deploy this capital in a maximum 2 years. So we built, obviously, we had the deal flow, strong deal flow anyway. So my understanding was the deal flow is the most critical part. The team behind the project is another thing. I will come back to it. And that was quite easy to raise this 50 million funding from these private equity guys. At the same time, I also sourced a flexible debt of 27 million. That was actually from a New York City-based institution. Obviously, they have a London-based office branch. But again, that was the interest-only 3-year maturity, and obviously with the option to roll over for another 3 years and for another 3 years, similar to bond-like funding. So pretty much you pay only interest quarterly, or I don't remember, 6 monthly interests on this loan, and you deploy this capital. You get this capital once you obviously kind of, get another acquisition. And that got me thinking, because obviously my background is a business. I built a number of businesses. I exited 3 businesses over the last 20 years. But actually this experience last year got me thinking that there is probably something else out there. And obviously raising this big ticket size capital is much easier than raising 100K, 500K, or maybe $1 million dollars or pounds. And that's true, actually. That's true because I've kind of experienced this again and again and again. Again, if you have any questions in the meantime, please interrupt. I will be, if not, I will be just carry on the next few slides. So, private equity and family office investors, because that's the investors I will be speaking about today mostly, and worth mentioning actually that today private equity and, as I said, venture capital firms, they have 4 trillion in cash looking for deals. And as I said, there is a tsunami of even more cash coming in. So again, we need to supply good opportunities for this capital. And family office world is another kind of source of capital. Speaking up family offices, whether single family offices or multi-family offices, typically they have a diversification policy in place, which means they often allocate part of their capital to various asset classes, including businesses in different sectors and locations to manage risk. So you just have to find those who actually at this moment are on the investment mode and they're looking to deploy their capital in this part of their investment policy. And I've come across a lot of these guys, again, mostly in the US, family offices in the US, but they're looking for opportunities in the UK as well. As you know, Americans buy pretty much everything now in the UK, including football clubs, healthcare, pretty much everything. So I at this moment, I give you another real life example. Actually, currently, I'm working with an EBITDA negative business raising 50 million for a roll-up. And however, we've modeled how after acquisitions and synergies, the business will become EBITDA positive in the next 3 years. And that works actually. So you don't need to be EBITDA positive straight away, which is, obviously it can be challenging to raise capital. But again, this situation, actually, these guys are EBITDA negative. They have 3 million in loss. However, since it is a highly ESG focused project, and I believe that actually helps us balance the lack of immediate profitability and attract investors aligned with these sustainability goals, because ESG is probably the most critical now kind of aspect to where the capital can be allocated. So even if you're doing roll up in manufacturing, for example, you need to think about this ESG kind of aspect in your group. It's because, again, they say 80-90% of the capital today, it will be deployed in the ESG focused projects. So it has to be kind of part of your business strategy, business model. Right. So again, so we spoke briefly about private equity family offices. Again, probably 50 million ticket size investments. That's, and you have to kind of build a project to raise this capital. You have to show your deal flow and you have to show your team behind this project. There's another actually way you can raise capital, and I was part of it as well a number of years ago. We put a small company onto the OTC market. OTC is kind of like over-the-counter stock exchange market in the US. So you can actually go public with a small company. That particular company was a 1 million revenue, a small company, internet industry company, but they had solid profitability. And we went public through a process called direct listing. This essentially means going public without raising capital or using an underwriter such as an investment bank. Therefore, the process is relatively cheaper than kind of an ordinary IPO. And what this has given the business is, they could issue bonds, and that was listed bonds actually, with 10-12%, I can't remember, quarterly interest, and making each acquisition accretive. The business raised more capital for further acquisitions, creating a positive cycle of growth. So basically, they borrow money, issuing bonds, and they buy a business. They borrow money, buy a business, borrow money, and that's kind of track record. They build this track record, and every single next bond issue is easy. And they finally moved. They recently moved onto the Nasdaq. So they moved from the OTC market to Nasdaq. So that's a very a great story. How you can raise cap, and pretty much you can do with any business, going public through this direct listing. Again, if you have revenue like 1 million, profitable business, cash flowing / EBITDA positive business, you're going public, you issuing bonds, listed bonds, which means you don't need to pay this back. You only pay interest quarterly. Once you build this track record, then you can raise pretty much unlimited amount of money, because investors nowadays, they like these fixed income products, and obviously bonds are fixed income product. You can also issue the preference shares. Probably you've heard about this. That's pretty much same. So you pay interest on this money, probably 10-12% if the risk is higher. Once you're bigger, you can probably go 8 to 10 maybe. That's another way how you can again raise unlimited capital over some time. And that's actually the better way, because you're not diluting your business, you're not diluting your shareholding, and you kind of creating this kind of perpetuum mobile for raising capital. As I said, yeah, if you buy profitable business, you raise money. You buy a profitable business, you raise money. So that's the strategy. Okay. So the most important, as I said, is the combination of a strong team with a proven track record, and obviously very strong deal flow. You have to have the deal flow already in place. So if you want to buy through 2, 3, 5, I just had a meeting with guys who have 28 businesses already spoken to and already had due diligence in place. 28 businesses, so they did a great job. And with this, we're just building the team around this project, and we can raise pretty much not any capital, but we can raise a lot of capital at this moment, because the deal flow and the team is the most critical. This is what the investors will be looking at. Obviously, you have to build financial models, pitch decks, etc. But that's technical thing. And once this is done, again, you have access to unlimited capital. And the bigger tickets are easier to raise. Again, if you're looking to raise 200, 500, that's challenging. That's usually if you're looking to leverage buyouts. As I said, I mentioned this several times. I don't like leverage buyouts using this kind of invoice finance facilities or whatever. I don't like this, because you have to offer your PG, and this is usually, again, it is better to probably focus on slightly larger deals, slightly larger groups, and raise much bigger tickets, like again 20 million, ideally 50 million, and that's much easier. If you can, it is probably just a psychological thing that you have to again, deal flow and team. Okay, guys, that's pretty much it for today. I hope you've got some questions, or maybe some your experience. I've got a question to you, but again, if you need any help with putting together a roll-up structure or preparing an investment back style pitch deck, building a financial model or raising capital, again, feel free to reach out. I would be happy to see how I or maybe some of my contacts can assist you. Again, the time is now. And I think this is not just a very good time to raise capital and to buy businesses, but it is a very good time to exit, because you've got so much capital, as I said, waiting to be deployed, and they can buy out you very quickly once you build this group. So it's a quick, hard, obviously work, but it is doable. And I've been involved in a number of projects like this. So guys, do you have, maybe I can ask, what's your biggest challenge at this moment, if any, obviously, in raising capital or scaling through acquisitions? Maybe you can share something with me, please. Nobody?
I've got a question, Marek.
Yep.
Even though I say a lot, realistically, I'm at the early part of my journey in M&A, and although I know a lot, I can add extreme value, there are going to be times when I do need to raise the capital, but it's very much at the lower end of the range that you have mentioned. So my question is there anything I can do to help secure that level of funding? Something like, I don't know, between 50K and 500K.
Obviously, yes, this is not my kind of experience. I personally would struggle to raise 100K versus raising 50 million. I would struggle to raise 100K. I don't know why, but I know this for sure, because this you have to speak to, maybe, I don't know, your family, friends, or accredited investors. And accredited investors, they have so much opportunities today to invest. They can invest in, the stock exchange is in the US, for example, is your competition, because the indexes are growing, and will be growing, because there's so much, again, money coming into this, and the Fed is manipulating this kind of. So I would personally rather focus on building something, probably something else, larger, the same but larger, maybe larger opportunities. I'm not sure, are you talking about M&A, or are you talking about what? Just maybe one acquisition,
M&A,
or?
M&A, acquiring companies. So thinking creatively, if you find it's that much easier to secure that level of funding between 10 and 50 million, how would you be open to having one part of your team looking at the kind of opportunities that we can bring to lend money to us? Have a think about it. I'm not asking for an answer straight away, because
Yeah,
I'm,
yeah,
I
yeah.
don't want to be seen to be,
No, that's again, reach out to me. Again, if you have, again, the most critical thing is the deal flow. If you have deal flow in your industry, whatever the niche is,
yeah.
then yes, I can, we can have a look at it, because I find raising large ticket capital not easy, but again, less challenging than, for example, managing such a project, doing these deals, talking to these guys, because I've done acquisitions as well. I've done 6 acquisitions. I know how challenging it is, how time consuming, how difficult, how many things can go wrong. And even post acquisition, so many things happened. There's always something. And the integrations, and so it's probably better to buy larger businesses, build a team, and raise more money. And that's easier. This is probably even less amount of work. But if you're looking to buy a first business, that's probably, maybe it's good to maybe raise this small amount, try to raise, or whatever, using creative. Because I used to buy businesses for using money, or not using money at all, even valuations like 2-3 million, and I'm not using my money. And again, the first deal, maybe you can be creative just to build some, like a track record. But I would rather build a team behind you and start looking for larger deals, because this is much better, to be honest. You're using the same language, you're using the same kind of due diligence, as you're using the same things, really. And you're talking more bigger money, obviously. So yeah, Pash, we happy obviously to. Gary, you raised your hand like in the school.
Thank you.
Yes, thank you. And thank you for the great content, Marek. So I'm doing a roll up in the US, and I'm looking at a few different options. Obviously, one scenario is, let's say a seller is willing to be creative, right? Seller financing, all those other options, right? And then there's other scenarios where somebody wants to scale through acquisitions, and maybe we do a YBO or something similar to that, right? I've been hesitant to raise capital because when I do a creative deal or I do a YBO, I have more access to the profits in the business to do what I want with it, right? My understanding is when you raise capital, you can get a management fee for managing the capital of roughly 2%. And you really get paid the most when you exit and you actually sell the business down the road. You get 20%, but the limited partner investors, they get 80%. So with all that said, I'm trying to figure out within this roll-up scenario where you got sometimes you want to do a creative deal, sometimes you want to do a YBO, and sometimes you may want to use capital. How do you determine when the best scenario is to use capital versus the other scenarios?
Okay, if I understand this correctly, so from my experience and from my kind of what I spoke to this, because I had so many conversations, I network with these guys, private equity family offices, and they usually kind of from $500 million to maybe 10, 15 billion dollars assets under management. So they still small, but they kind of, relatively big to what we're doing here. And to be honest, if you want to mix all of these strategies, it would not work for these guys. They will not invest in you. You have to have just one clear strategy and just focus on the niche, on bringing a lot of deals in this niche, because they know that post-acquisition integration is very difficult. So if you bring very small businesses, you using some creative finance because this business wasn't doing well, great before, whatever, it will not work. Probably you have to maybe separate those two kind of, or maybe three approaches, and build a healthy, EBITDA positive. Could be that private equity, they like that. They okay with not like, but they okay with that. Because actually they actually, this is slightly different world. They more EBITDA orientated people rather than cash flow or profit, kind of net profit, as we do. We more about cash flow because we want to make some quick money. However, they actually they know how to increase value by, again, focus on EBITDA. I spoke about the EBITDA last time, so if you have a time, maybe you can have a look on YouTube. But anyway, I would just probably totally separate those two strategies because it will not work. You have to buy those businesses that they have to be profitable, same niche, pretty much not same size, but at least some minimum size, let's say $500,000 of EBITDA, whatever. And you have to use kind of the same strategy for valuations and for structuring the deal. You can still use the seller finance, because you want these guys ideally to stay for some time. You don't want them to leave straight away because that may be a red or amber flag for investors. So your strategy is clear. EBITDA positive, at least $500,000. These guys stay. They exit, for example, for the next 12 to 24 months. And, this kind of, you're not doing any more creative structures here, because that will raise questions, that will raise red flags for these guys. It has to be clear strategy. Do I kind of correctly understood the question?
Yeah, you did. And so it sounds like it may be beneficial to, let's say you have one group of companies that are being creative. They're not really ready to sell yet, right? They need to get better and more attractive. And then I have, let's say, a fund, a private equity fund or capital or whatever. Once these companies over here get to that level, then I can use that fund to buy those companies. Basically kind of buying for myself if I have a
Yeah.
YBO strategy or whatever.
Yeah, absolutely. Yeah. I've heard about. Yeah. You can absolutely, you can do it. Yes, you can do it. Yes, this is another strategy. Obviously, yeah, you're doing your. Yeah. But you have to build some platform that this guy. You have to, if you understand what the private equity guy is looking for, and you can build this platform for them, and an exit to them, because they know how to make money. They're very clever. And they're very focused on squeeze the EBITDA, squeeze the valuation. So obviously they want to double, ideally triple their money over the next 5, let's say 3 to 7 years. And whether your platform will help with this, will fit to it, that's the question.
So
yeah.
And just to be clear, so it would be my private equity firm, right, with capital that I've raised, but I would also have a separate business, if you will, for these distressed companies that are getting to that level where they need to be. And then I'll use my private equity fund with capital I raised to buy those companies when they get to the right level, when let's say they're merged together.
No. I don't think that would work. I would. Sorry if I kind of misinform you. No, I'm talking about raising capital from private equity firms to buy businesses. So you offer some kind of equity in your group, 20%, 30%, whatever. It depends on the strategy. Sometimes 70%, depend. Whatever the strategy is, and so you raise money from day one, and they obviously committed the money to you. You bring the deal flow. Once you buy first business, they send the money. Then you buy another business, they send money, and that's kind of, you're not building your private equity firm, and you buy and you invest in your businesses, because that would not work. You can build your private equity firm, but you cannot buy your businesses, because that it doesn't work. It doesn't work. The private equity firm, the investment policy has to be clear, and it cannot be kind of related, companies related. It's totally different world. So
you can't buy from yourself if you have a private equity.
That's obviously that biased acquisition. That's absolutely not the case for setting a private equity firm, which is still doable. But again, going that way, raising capital or going public, you will end up with more profits, more kind of equity event profits, because you're building, you're not diluting yourself. So so building private equity is totally different kind of world. I'm not speaking about that, to be honest.
So Marek, what kind of team, when you talk about the teams that these strategies require, what would a typical team look like in your eyes? If you said the team would be one of these.
Yeah, so Fred, that's a very good question. Again, that's the most critical question, because team is, again, as I said, deal flow and team is critical. There are two things. So they like to see obviously operational people, strong operational people with some kind of 100 years experience combined, for example. So you've got maybe 1, 2, 3 people, and obviously you bring this new businesses into the group, so you still have some skills anyway. So again, you've got operational, industry orientated and industry experience, this industry experts within your operational team. Again, maybe 3, 4 people. Plus, you've got more strategic team, like an advisory board, or like non-executive directors, which you bring these guys probably for 1-2 hours a month, and you offering them stock options, like vested, when we exit you get this, but you're not paying them, obviously. And these guys, ideally, if they have they have 50 years plus, and they have experience within the PLC companies, not particular in this industry. It could be related industries, but also from this they can be ex KPMG, PwC, these big four companies as well, legal department, financial departments. You can actually get one of them to being your chairman, non-executive chairman. And again, probably 2 or 3 of them at least, this kind of gray hair guys out of the industry, out of your kind of scope of focus, and the capital likes this kind of mix of strategic and operational team. So you were talking, well, maybe 6-7 people, yeah, to raise this 50 million.
Brilliant, thank you.
Okay, guys. So yeah, do you have any more questions, or maybe some stories to share with your capital raise, guys?
Marek, can I
Yeah,
ask
Marek,
go
sorry,
ahead.
just to jump in, Marek, just on that question of the board of directors. I hope you're all right, Marek. Yeah, so does it make a difference if they're on the board of advisors or they have to be actually sit on the board of the company? Does it make any difference?
Sorry, I cannot hear you. I have to probably mute somebody here.
Yeah.
Okay, can you please repeat? Yeah.
Yeah, so I was just wondering the question of, if it makes any difference for these guys to be sitting on not the advisory board, or they have to be actual non-executive directors within the company. Does it make any difference?
No, I don't think so. I don't think so. It makes any difference. You have to have them on your pitch deck, and you have to have them available if these guys, the capital guys, wanted maybe to have a chat with them. Yeah, whatever scope they with you at, that would be great. That would be great. Again, just offer them some stock options, and obviously once a month you can meet with them, 1-2 hour online meeting. You can discuss your deal flow. You can discuss your kind of whatever, it's good to have them anyway, and they have contacts. They can bring a lot of, this is my experience, another experience actually, when I used to work with the Deloitte in Portugal, and actually I was buying 5th largest company in Portugal in one industry, and they actually said, okay, Marek, so yeah, we have another company in this space, so we can structure the deal for you, that so they helped me they brought this 2nd largest company in this space. So I had 2 companies in the same space to buy. Obviously then COVID happened and this actually collapsed, but again, this is another thing why it's good to work with this ex Big Four, having them on board, and capital obviously likes it. Yeah. Are you guys raising any capital at this moment, small tickets or bigger tickets?
I'm in the process of forming which is kind of reason for my questions earlier. I'm in the process of forming a private equity fund to raise capital. And so I'm putting the team together, getting the pitch deck together. I have a list of accredited investors, but it sounds like, based on what you're saying, it may be an easier path to reach out to family offices instead of accredited investors. Is that a fair statement?
How big is the private equity? What capital you're raising? What kind of amount of?
I'm working on that. I'm working on what that would look like. What I'm thinking of the companies around the U.S., and which is part of the reason I was asking those questions about if I'm only using capital, right, and I'm not doing the creative structures like we talked about, and I'm just using capital to get the deal done. It could be $50 to $100 million, right, to do the down payment, working capital, put the team in place. Do you feel like that's an easier path than all the creative strategies and the management of that?
Easier. Maybe easier, and definitely not probably easier, because again, structuring, I've got some experience in building a private equity, actually venture capital, because I'm actually at the latest stage of building a small venture capital. in Europe. So I know what it takes to, we're actually doing this in the US, but we will be investing in startups in Europe. So building a venture private equity fund is a really tough job. I mean, in terms of the paperwork, all this legal documentation. I'm not sure if you already have this in place.
Yeah.
You've got this.
I'm in another group that just does private equity funds. So I'm
okay.
So I have a lot of support on the legal and that sort of thing. But as far as I guess I haven't started raising capital. Everybody talks about how difficult it is. Now, I have a ton of deal flow, and the plan was that my business owners that are providing deal flow could be investors, they're accredited investors. But I don't know if that's the better path, to be contacting them or be reaching out to family offices to raise a bigger dollar value to do more deals, basically.
Yeah, family offices, as I said, all these guys, they have a lot of cash now, and they have, pretty much not everybody, but most of them, they have, as I said, investment policy. They want to diversify their asset kind of portfolio. So part of the capital going to businesses, going to other private equity. I know this for sure. Yeah, family offices, I think, is a very good direction. But again, I'm not clear about your strategy. So you basically building a private equity firm, and you will be investing or buying out businesses.
Yeah. So my background's in air conditioning and plumbing companies. So the assets I'm looking at are smaller than some of the larger private equity funds. So I'm turning those companies around, putting the right teams in place, and so the capital would be invested in marketing, team members, working capital, down payments on deals, and then the plan was to use seller financing, so I don't have to involve banks. And because the owner would have, let's say they seller finance 59% or 49% of it, or whatever the number is.
Yes.
But it sounds like having that capital ready to go and deploy that versus trying to do a bunch of creative strategies. I'm thinking I could probably get more deals done with capital ready to go versus, every however many companies willing, because not every company is willing to be creative. Not everyone's willing to do a zero down, unless they're super distressed. At least that's what I'm experiencing.
Yeah.
But if I have capital, then I do the down. It seems like I could get the deals done faster and maybe have less risk on myself.
Private equity definitely is about minimizing your risk. That's for sure. That's for sure. Listen, it's a very good strategy. I think they going to raise capital from private equity and offer them we doing the roll up within an industry. I think that's easier. Private equity is probably slightly more challenging because you probably even need, in my opinion, need to have even stronger team, stronger track record to raise capital for this kind of business model. But yeah, you're right. You've got capital. You just go buying businesses, and banks will co-invest. Banks always come across, kind of with some lending, and private equity. They're very okay with lending, with debt, because again, they're looking to enterprise value, which kind of the debt doesn't really matter, and the EBITDA and enterprise value is the most critical, for valuations. But again, team will be critical, because buying a business is not a problem today, but running them and kind of whatever, streamlining operations, bringing more staff or whatever, doing this post-acquisition integrations, that's a very challenging part. So how do you prove to your investors that you are very good at it? Again, still great. I will definitely speak to fund of funds and speak to family offices as well. If you're looking to raise 50 to 100 million, so probably you're looking to speak to guys who have like $500 million at least, $500 million at least assets under management, up to maybe, I don't know, 5-10 billion. That's your range, kind of, because the larger, they will not be interested in this ticket size. The smaller, Well, maybe the smaller, yes, because they can give you like 1 million, 2 million, or $500,000, whatever. Yeah, that's but again, doing roll-ups, this is what I spoken about. Doing roll-ups, you've got probably 1, 2, 3 investors. You've got one leading investor, big private equity, the small private equity firm. As I did as I said, in the UK last year, that was 50 million equity funding from one private equity and lending. So I had 2 investors actually involved in this roll-up project. That's easier.
When you say fund, let's say I'm raising capital for my private equity fund, and I'm also doing like a fund of fund where another private equity fund is putting capital into my fund. So the reason for them willing to do that would be to have access to the assets once they get to a certain level for them to own them. Is that right? Or
no, they obviously become your LPs. So they just looking,
okay.
yeah. No, they become
they
LPs.
just want to diversify basically the private equity fund.
No. They becoming your LPs. So they kind of one of the investors. So that's the strategy. Yeah, that's the strategy.
Okay.
Yeah. So you've got paperwork in place. Have you got team already in place?
Yeah, so I'm building the team. Legal is paid for. I'm getting all that. I have a ton of support. I'm just trying to figure out what the thesis would look like, and that's why I was asking about the creative versus the funding, because there's so many different scenarios, and whatever one I pick,
Yes.
I want to pick one that has the highest chance of success. And it sounds like not involving all the creative stuff. I can still focus on the smaller deals that are people are overlooking, because the multiples are a lot less, and I kind of see it as less risk because 70% of acquisitions fail. So if you buy a bigger company at a higher multiple, your team may leave, and then you got to go high. But if it's a smaller company, if the team leaves, it's not like I'm hiring 20 people.
Yes.
I'm hiring a couple people. But I'm really leveraging like the Google business profiles, the websites, the customer list, all that stuff. And then I want to use the capital to put into marketing to really scale it.
Yeah. Again, I think your deal flow, I would start always with deal flow, whatever the strategy you use. Deal flow will kind of shape your strategy, the ticket you're raising, the exit strategy, your deal flow, your industry and your deal flow. And, if you want to raise, you mentioned 50 to 100 million. So for example, 50 million. So you're looking to, usually private equity firms, the fund is looking to invest like probably 8 to 12 projects, 8 to 12 businesses, or buy out 8 to 12 businesses. So your valuations will be like probably around 5 million to maybe 10 million. So you have to have the deal flow. If you have larger company deal flow, then you will be looking probably to raise more capital. Again, the deal flow will shape your strategy really.
I have a ton of deal flow right now, but the companies are like in the 1 to 2 million revenue range and 300,000 to 500,000 in EBITDA.
Yeah, so that's another challenge. Again, that's just my personal opinion. I'm not the specialist of PE world, but this is what I know from my personal experience and when I talking to these guys. You may struggle to raise capital from these bigger guys because they do understand that small businesses are very high risk, especially in the current environment. The business landscape is changing, and to be honest, we have weird times. Everybody is talking that we've got a great economy, whereas if you look the numbers, the economy is actually collapsing at the fastest pace ever, if you see some of the numbers. And these guys know, because the big capital, they very clever. So if you say you buy these small businesses like 300,000 EBITDA, probably you would challenge to raise capital. So better to find larger company deal flow, to be honest, and that would be much easier to convince investors to invest. And that's the challenge, because how many deals you can find? There is so much competition in this space, so much.
Yeah.
If you can convince the big capital to invest in your fund and you buy these small companies, you will be the very, very good guy. You will be the world champion, to be honest, if you can convince those guys. Because we know that this is still a lot of value to be created with these small businesses. But the capital, even though they have cash, they will not invest in that because they know they don't understand the small business. So how we can convince them? We understand small business. We know what to do with them. Give us money, we can do it. That's the conversation you will have. But once they see the deal flow, I think that you will struggle to take the conversation to the next level to kind of try to convince them.
Hey, Gary.
Yep.
Hey, I'd actually be interested to have a chat with you because I'm in a very similar position to yourself. Now, I'm trying to also raise capital, but rather than go down the private equity capital raising approach, I've actually gone for raising capital through a debt fund. So, you talked about, you raise this capital through private equity and you effectively have to give away 80% of, whatever you kind of are successful with. I figured with a debt fund, actually, you don't have to. You give a return on the on the capital raise, right? So who knows, maybe it's 15, 20%. And if your deals work at 15, 20% with the debt fund, then you get to keep 100% of the equity of the companies you're buying. So that's the route I'm currently going down.
And that's been attractive. That's been attractive to the investors.
So interestingly enough, I'm not at the stage where I'm going out to investors yet. What I've done is I've got a team together. I'm pretty early stage, team together, decks pretty much being formed now. And what I did with the team was, and funnily enough, the team are all private equity individuals. And they're on board with this because they understand the model. And what we're trying to do is get something tangible together so we can then go out to start pitching to family offices and stuff like that. And we're very close. The decks are actually nearly finished. So we're pretty much nearly at the stage of marketing this this proposal. And we'll see how it goes. But that's why I said maybe we could have a chat because you're going down one route, I'm going down the next, and we can maybe, cross ideas and see how, it works out each way.
Yeah, absolutely. And I've thought about that. The debt fund model. I know a lot of times these investors want to participate in the upside, at least from what I heard, right? I haven't started raising capital either. I've just been having conversations, so I didn't know but if they're not attracted to the smaller companies, maybe that's the route I have to go.
Yeah, precisely. Because with a debt fund, you can be a lot more flexible. If they are interested in upside, you can fund with some sort of convertible note, right? Where it, after a period of debt, it can convert into equity, and you basically pool some stuff together, a few companies together. Maybe you go and list that, and then they get the upside, like you said. I just think it's a lot more flexible. Trying to do it that way, and debt is a lot simpler to understand, right? It's like, you give us some money and we'll give you 15% return on that money over a certain period of time. It's pretty simple in my mind. Whereas I think what Marek was saying with private equity, your team has to be a lot more solid, robust, and have a lot of experience with private equity. Whereas debt, you can even just go and give it to some brokers and, they'll find the deal, the people to invest for you. So that was the rationale for my way of thinking. And again, like I said, I'm pretty early stage with all of this, but maybe we could have a chat and we can, like I said, cross-pollinate ideas and see how it works out.
Yeah, I'd love to share some ideas, and I like that idea with the convertible note. That makes sense. And like right now, I'm building out I found this one team member who worked for some multi-billion-dollar private equity firm, Morgan Stanley. So I had a conversation with them last week. So I'm talking to these team members, pitching them on hey, you want to be a part of this. And so I'm kind of building out that team, but I could always do both. If I have an awesome team and it's a debt fund, it should be the best of both worlds, right? But I would like to talk. So you're in Harbor Club, right? So I can just send you a message.
Just find me, Andre Barrett. I'm in the Harbor Club. I'll look out for you as well.
Yeah, awesome.
Thank you, Andre. I think this is another great strategy. Debt. Some of these investors, they specialize in debt, so they're looking for fixed income kind of products, and obviously give even bonds. As I said, even issuing bonds. That's probably much easier than starting a private equity fund, debt fund, because you're just you're just issuing bonds, and that's probably cheaper and quicker.
That's one thing I was going to ask you about, actually, Marek. You mentioned about listing on the OTC and then trying to raise capital through some sort of bond issuance. Can you talk in a little bit more detail about that? Like how, which OTC would it be? Like what's the process for going through that? Even the process of like creating the bond, does it have to be a certain size, that type of thing?
Yeah, so obviously, issuing bonds, you don't need to be listed company. In fact, however, my conversations and my experience is, if you are listed company, even on the OTC, for example, you've got different tiers on the OTC. We've got OTC QB, OTC QX, and obviously the pink sheets. So probably we're talking about this kind of second tier QB, and being listed company even on that tier, it gives you some credibility. It obviously you have to have the audit in place. You've gone through some kind of a legal process, so investors actually will trust you more than if you are a private company. Again, you're going to be listed through the process called direct listing. So this is much cheaper process. Still costs probably $200,000-$300,000 to go there, but again, you can raise actually money for this process, and once you're listed, then you can issue again. Once you're listed, you're a credible company, and you can raise bonds. You issue bonds, listed bonds, which means again, you only pay this, for example, quarterly interest on these bonds or preferred shares to investors. And again, some of these investors, they specialize in fixed income investments, which obviously this will be fixed income because you pay regularly 12%, for example, every quarter, 12%, annually, obviously 12% interest to them, and you're building track record. So you actually, and there is so much money actually looking to be deployed as a fixed income, as a debt, they look into debt platforms. So yeah, that's another, obviously, that's much easier than creating a fund, because you've got just one small business going listed. You raise money for accretive acquisition, which means you're bringing a profitable or EBITDA positive or cash flow positive company into the group. So you've got cash to service the debt, and investors will understand this kind of the momentum you're building. You're borrowing money, you're buying a company. You're borrowing money, you're buying company. That's kind of, as I said, the perpetuum mobile, which I've experienced a number of times with some other guys. Once you've got the valuation in place, I think the minimum valuation is 45 million. And you can move to NASDAQ, where obviously this opens a lot of more doors for raising even more capital, and obviously growing your net worth by obviously increasing the valuation of the company. Yeah.
It sounds like a really good approach, and I'm quite intrigued by it, because the problems I've been having is that whenever you go to borrow money, they're always looking at historical cash flow. And, if the company hasn't done so well over the last couple of years, your chances of borrowing money are pretty, slim to none. However, the model you're talking about, where you're borrowing for accretive acquisitions, it's effectively looking at projected cash flows. And projected cash flows can be, vastly different to historic cash flows, right? And so if it works on a projected cash flow basis, then you're obviously able to raise a lot more money that way.
Yeah, you're absolutely right. You understand this rightly. So you obviously, your financial model is actually you put the target, the acquisition target cash flow into this, plus the synergies you will obtain from this acquisition, and this must service the debt, which probably again 12% is the good starting point. Now we have, the competition is getting less, because we've got this interest rates going down, so probably 12% will be very, very attractive to these investors, and they are there. As I said, actually that was the strategy advised by some ex-Wall Street guy to me some time ago. So we actually, he's done this many times. I was involved in one of this, and it works. It works. There is so much money. He says we can actually raise unlimited amount of money this way. again, deal flow is the most critical thing. If you have a proper, strong deal flow, this will kind of affect your strategy. So and you're not diluting at all, because you just, as you said, that's much easier.
Is there a resource or book that, so I've been studying and I'm in this group for funds. So like funds sound easy to me because I've been studying that, right? But I do like what you're saying on the bond scenario, but is there some kind of resource or book that guides you like kind of step by step? Because for me, I like to like see all the details. But
I'm the same, Gary. I was going to ask exactly the same question. So
are you guys engineers? So
I am an engineer, yes.
Okay, that's clear. Okay.
Yeah, I have an engineering degree. Yeah.
Okay, I knew it. I'm not sure, to be honest, because that's I haven't read any book about that. Obviously, I read a lot of books about the capital, private equity. I'm a finance student as well. I've been for the last 20 years really. But I cannot think about anything about the bond strategy, to be honest.
So we just need a JV with you then, right? Is that right?
Yeah, maybe, yeah. And with my team, there's so many strategies out there today. As I said, guys, there's capital waiting to be deployed. We just need to bring strong deal flow, making sense deal flow, and a good team behind that. Capital is not the problem at all today.
And Marek, you're in the Harvard Club app, right? So if we want to discuss a possible JV advisory role kind of scenario,
please reach out to me. Yes, absolutely.
Okay.
Yeah, you guys, you've been doing great things, and obviously you're based in the US, where there is the best place to be. Because again, there's tsunami of money coming into the market, and so yeah. So but at the same time, I guess there is so much competition within these business buyers, business investors. So there is so much competition. So how you differentiate yourself to build this strong deal flow? But I was in the healthcare last year in the UK. The valuations were, very crazy. These small companies, they were bought actually by Americans, like 7, 8, 9 times EBITDA. I couldn't compete with them. That means they have capital too. Guys, thank you very much. Okay, listen, we can actually keep talking offline. Maybe, if you reach out to me over the Harbor Club app, or just maybe, through LinkedIn, Marek Niedzwiedz. That's a great meeting, great conversation. So thank you very much for your involvement today, guys. Thank you very much. Speak next time. Thank you. Bye-bye.
Thank you.
Bye.
Thanks, Marek. Bye-bye.